The first thing to know about this options chain tool is that it helps you explore different option contracts based on your own research and market outlook. At the top, you'll see a list of expiration dates. These represent when each option contract expires. For example, if you're looking at a call option and the stock price is above the strike price on the expiration date, that contract is considered in the money. That means you could either exercise the contract to claim the shares or sell the contract for a profit. On the flip side, if the stock price is below the strike price, the call expires worthless, and it's a loss. For put options, it works the opposite way. You're betting the price will go down, so when you're doing your charting or research, ask yourself, do I think the price is going up or down? If you think it's going up, you might consider calls. If you think it's going down, you might look at puts. They're a way to benefit from a downward move. This is just a quick highlight of how it works. Now let's look at a real example. The expiration date I'm viewing here is June 25th. So if I were to buy a SPY call contract with a $594.28 strike, and the current price is $594, then I need the price to rise above $594 by June 25th to be in the money. Here's a cool trick. I can mark that $594.28 level on the chart with a horizontal line. Double-click coordinates $594.28. So what I've just done now is I've put a horizontal line here exactly where that expiration date needs to be. That helps me visually track where the stock needs to go for the trade to be profitable. It's a simple, effective way to combine chart analysis with options data. As I scroll down the options chain, I can see other strikes, $595, $596, $597, all for the same expiration date of June 25th. And just like before, each one of these contracts will only be profitable if the stock closes above that strike on expiration. Now back to the EXP menu. This lets you quickly click through different expiration dates like June 25th, June 26th, or even weeks out. If you go really far, like out to 2026, you'll notice the expiration dates are more spaced out, usually by months. That's normal for longer-term options. So now let's understand more things in the option chains. Yeah, as I mentioned, the chain is split into two main sections, calls on the left and puts on the right, with strike prices running down the middle. This layout makes it easy to compare calls and puts at the same strike price. In the center, you'll see the strike count drop down, which lets you control how many strike prices are displayed. This helps you focus on the most relevant prices for your strategy. Each side of the chain comes with a detailed set of columns. Change shows how much the options price has moved since the previous day. Delta is a key Greek. It estimates how much the options price will change for every $1 move in the underlying stock. Implied volatility reflects how volatile the market expects the stock to be in the future. It's a major factor in option pricing. Volume is the number of contracts traded for that option today. Open interest shows how many contracts are still open and not settled. High volume and open interest usually signal strong trader interest. Mid is the average of the bid and ask prices, often considered a fair value. Rib is the highest price a buyer is willing to pay, the price you'd get if you sell. Ask is the lowest price a seller is willing to accept, the price you'd pay if you buy. To build a strategy, you simply interact with the chain on both the calls and put sides. You'll see buy and sell buttons. Clicking one opens a menu with options like buy to open or sell to close. Let's break down the four key terms. Buy to open. You're entering a new position by buying an option, expecting it to increase in value. This is the most common way to start a bullish trade. Sell to open. You're selling or writing an option to start a new position. You collect a premium hoping the option loses value or expires worthless. Sell to close. If you previously bought to open, this action lets you exit that position, ideally for a profit. Buy to close. If you previously sold to open, this is how you buy the contract back to close the trade. Once you pick the right action, the trade leg is added to the strategy builder at the top. Each leg is shown as a small box with the expiration date, strike price, and action, buy, sell. As you add legs, the calculator updates in real time, showing you potential profit, loss, and live Greeks for your entire strategy. You'll also see two key options, clear all to reset everything, or analyze with graph, to open a visual profit-loss chart of your strategy. Example strategy. Let's say I add a 585 call, buy to open, and a 586 call, sell to open. This builds a bull call spread. When I click Analyze with Graph, the system instantly visualizes this strategy, helping me understand my risk and reward before placing the trade. From selecting a ticker to analyzing multi-leg strategies with real-time P&L in Greeks, the SensaMarket Chain page gives you everything you need to make smart, informed decisions. Thanks for watching, and I'll see you in the next video.